fellow freedom builders, and welcome to yet another episode here from Building Freedom. Today we're going to look at stock analysis. And I know that some of you think that, oh, this analyzing stocks is a bit tedious and boring, but it is not. Today I'm going to show you two different strategies or two different schools of analysis. And this is, in the stock world, almost a religious question. Do we like one or do we like the other? Today I'm going to tell you about the two different methods or schools, and at the end of the video I'm going to tell you which one of the two I think is the best. Alright, let's get right to it. First of all, I'm going to show you something on the whiteboard here today, and then we're going to go into the computer and I'm going to show you some examples of what I'm showing you here on the whiteboard. The two different schools of stock analysis is called technical analysis and fundamental analysis, and they are very different. Technical analysis is a study of price in a chart. I've drawn a trend here. It could be a stock price, it could be gold, it could be a currency, it could be anything. But this price is going up, and a technical analyst would say, well, this is in an uptrend, so I'll try and buy on all the pullbacks here, and I don't really care why it's going up. I can just see on my chart that it is going up, and that is enough for me. A technical analyst would say that all the knowledge in the market about news, about revenue, about earnings per share, about everything you can imagine about this company, new management, new products coming out, everything is in the price already. And when the price starts to change direction and go the other way, the technical analyst would say, stop, I'm out, and then he or she would exit the position. Doesn't matter if there are any news coming out, if they can see that sellers are coming in, they'll get out. That's basically it. So technical analysis is the study of repeatable patterns. I know there are some technical analysts that try to claim that they have some magic methods that they can predict where a price will go and for how long and at what price, and they're going to sell you all sorts of different expensive indicators. I wouldn't buy them if I were you. Technical analysis, as I use it, because I use a mix of these two, I can tell you already now, technical analysis as I use it is basically just to see what are all the big players in the market doing, and as long as they are buying, I'm buying. As long as the big players are selling, I start selling. It sounds a bit more simple than it actually is, but I'm going to show you on my computer in a second. Let's take a look at the fundamental part here. The fundamental analysis can be divided into two different directions. We have the quantitative fundamental analysis and the qualitative fundamental analysis. I know that can sound a bit strange, but just follow me here. The quantitative fundamental analysis is they are analyzing all that can be counted and measured. That could be how much products are sold, what is the revenue, the profit margins, the earnings per share, the dividends, everything that can be counted. And I'm going to show you examples on that as well. Whereas the qualitative fundamental analysis is looking more at the quality of the company. Do I like the management? Have they performed well in other companies where they have been CEO or etc.? Do I like the product? Let's say that you have a product that is meant to be sold in China, and you can see that the group of people in China that could use your product are growing massively. Then a qualitative fundamental analysis will say, well, there's a growing market for this, and this is a high-end, good quality product. So our analysis say, yes, this is a stock to buy. And there are a lot of different other things they can look at, but basically they are looking at, do I trust the company, do I trust the management, do I trust the product, and do I trust the future for all of these? That's basically it. This one can be the hardest one to define, because it is a bit muddy, this one, and every fundamental analysis has his or her own take on this one. But let's have a look at the computer and I'll show you how the different things looks. Alright, we are at the screen now, and as you can see, I'm looking at Facebook stock here. And I think most of you know Facebook, I'm pretty sure. And that is one of the reasons why Facebook is such a large company. Millions and billions of people are using it every day. Here you can see a stock chart. And if you're not familiar with the stock chart, I can tell you that this is the price movements. Every single one of these red or green bars are 1 day of price movements for the Facebook stock. Meaning that if you have bought it here, down, and you were good or lucky to buy it straight at the bottom here, and you are still in it, you would have made something like almost 21% since June this year, 2019. So this is the price movement, and a technical analyst would simply look at this price movement and say, are we in a trend? Are we not in a trend? The colored things underneath here is the volume, showing us how much is bought or sold of this every day. I'm not going to go into depth with this technical analysis right now because I'll do that in a later video, and today we're just going to look at the differences between the two. But a technical analyst might do something like drawing a channel, something like this perhaps, and saying, right now we're in an uptrend and I'm going to buy here or here or here, and all of a sudden the uptrend is broken and they might sell, and they might enter again, and so on and so on. This is what is called just simple price action. We're just looking at the price. But the technical analysis can also use something called an indicator, and down here we have one of the most common indicators, something called a relative strength index, and I'm not going to go into depth with that as well today, but this one can be used on a number of different ways. It can tell us are we in an uptrend. For instance, from here we're in an uptrend, yes, then we can buy the stock. Some people tend to say, well, when it's too high it is overbought, meaning that we think that the people are going to take some profit off the table now, and we can see around here it starts selling off. And when it's down here, some people are saying, and when I say some people, it's because I'm not really into that, but some people are saying now it's oversold, and here, well, it hits pretty well here, so we should just enter here and stay into, we get into some overbought area again. Right now it seemed almost too good to be true, and it is not the certain way to make money. But an indicator is just a way of taking the price data up here and put it into a calculation and visualize it down here, so we can get a bit more simplistic view of the prices. So what a technical analyst actually does is that he or she is looking at the psychology in the market, is trying to figure out, are the buyers extremely greedy right now? Are they jumping in faster and faster? Or are the sellers trying to come in and the buyers are getting a bit nervous and starting to sell out quicker and quicker, and so on? I'll have an entire video just about the psychology in the stock market, but this is basically what technical analysis is. And I know some people are trying to say that this is almost like astrology or some thought of some kind of weird magic that we are trying to perform, but it is not. It is just it is a game of repeatable patterns. I have been doing this since 1987, before I had a computer, and I did it on a piece of paper at my parents' house, and it works pretty well, and I have earned quite a lot of money on it over the last 30 years or something like that. So it is something that can work, but it also takes some time to learn. But this is technical analysis. If we look at the fundamental part, at least the quantitative fundamental part, then here is an example of the financial summary of Facebook as well. And as you can see, there are the years 13, 14, 15, 16, and so on. And we have some estimates as for the future of 19 and 20 here. And you can see the total revenue. You can see at the bars in the right that the total revenue of Facebook has been going up quite massively. The operating profit is quite okay. Net profit, you can see EPS, that is earnings per share. You can see how much that grows. You can see all sorts of different ratios, PE ratio and PEG ratio, and I'll get into that later because they are very good at. It is good to know when you're investing. You can see the return on assets and return on equity, and I know all of this to some people new to investing can sound almost like complete Russian or Chinese, but knowing how to read these numbers can actually be quite good for an investor. So a fundamental investor, he or she is looking at economic factors. They're looking at earnings and cash flow and balance sheets, and they are looking at causes that drives the action. So they are not just looking at a chart saying we don't care what drives the action. The fundamental analysis want to know what drives the action, and then they want to look a bit into the future, into the future on the estimates and saying, well, if this has driven the price up, and we can see this estimate is that the price will keep going that way, or the earnings per share or revenue or profit will keep going up, then we think the price of the stock will go up and we will buy. But we will not buy just by looking at a chart. We'll buy by looking at fundamental factors, and that is mainly the differences here. Two analysts, a technical and a fundamental analysis, can buy the exact same stock at the exact same time, but they can do it with two completely different arguments or reasons, but both of them can make money in the market. So let's get back to the whiteboard, and I will show you what I think is best when it comes to this analysis battle. Alright, we are back at a whiteboard here, and when I said that I would tell you which one is best, there is a little nuance here we should know, because what is best here, in my opinion, depends on how much time you have, meaning how long a holding period are you looking for. If you want to buy something that you want to hold for 5 or 10 years, one of these methods I think is the best. If you're looking for some quicker trades that you might be in for a week or a month or maybe 3 months, then the other method can actually outperform the first one. And let me show you what I think here. The technical analysis is very good, in my opinion, when it comes to shorter price fluctuations. I'm not looking down at 1 minute charts and 5 minute charts like some day traders are, but I am looking at weekly and daily charts when I'm looking at a stock. So this can definitely tell me something about, are there certain levels where the buyers are coming in? Are we starting to have lower tops and lower bottoms here? Has the price changed? And all this stuff. Technical analysis can really, really be a benefit when we are looking at stocks to invest in. And we might get a good stock tip, we might read in the paper or on Facebook, and we might get a good stock tip from a friend saying this and this XYZ company is fantastic, it is going to blow through the roof. But you can see at the price chart that the sellers are coming in faster and faster. Someone is dumping this stock. Then this is not the time to buy. Unless you are good at what is called bottom fishing, trying to figure out when it's going to turn off. I'm not particularly good at that. So what I'm doing is that I'm waiting for the trends to turn, and then I am getting in at a later point. That part is called trend following, and I'll also get back to that later. But technical analysis, in my humble opinion, is an outstanding method of making money in the stock market in the shorter term. But in the beginning of my career as a stock investor, I was all in the beginning in 1987, I was long term. I just bought some stocks I didn't really know why. I did a bit of technical analysis, as I mentioned, on paper, but nothing big. But as time went on and I got my own computer and I could do some analysis and charts, I was what you would call a swing trader. I was in for maybe 3 days or 5 days or 10 days in stock, and then I would sell it again. At that point, the fundamentals doesn't really matter. If a company is estimating that in 3 years it would have doubled its sales or its profits or whatever, it wouldn't really affect my position for 3 days. But now, at the place I am in, where I like passive income, where I like income that at least I should not be glued to the screen 24/5 each and every day, then fundamental analysis is important, because today I'm holding my stocks for 3 months or 6 months or a year if it keeps going in a good uptrend. And here the fundamental part is crucial, because if I want to be in a stock for the next 2 or 3 or 5 years, I don't want to buy into a stock that doesn't make money, that is almost bankrupt, where the CEO is indicted for fraud, or I don't know what. I want to do my due diligence here. I want to look at the numbers, and I have some good tools that I'm going to show you in a later video that can quickly do that. You don't have to have a degree in accounting or something like that. There are some very good tools on the market today, quite cheap actually, where you can do all of this in just in the blink of an eye. So the combination here with the fundamentals, where I'm looking for good solid companies with good growth in their numbers, and then I'm spotting when the trend is changing and I want to jump in and ride along with the big guys in the market, because I'm not smarter than they are. So if I have found a good solid company and I wait for the big guys, the big funds to get into the market and start buying, then I can make money. And when they start to hesitate and saying now the trend is topping, now we think it's getting too expensive, then I'm getting out as well. There's no ego involved here, because I know that I'm not smarter than them. I'm just following what they do. And that can be quite profitable. And I'm going to show you in these videos on this channel exactly how I do it. So a combination, and I promised in the beginning that I would tell you which one I think was the best. This one, in my opinion, if you're a very short-term trader, then technical analysis is king. If you're a bit longer term investor, from at least 6 months and upwards, the fundamentals are the things that moves the prices. This is just price movement, but there is a course for this price movement, and that one is the fundamental. So if you are a longer term investor, you should consider the fundamentals as well. Otherwise, you are not really playing your cards right, and we want to have the best edge possible when moving into this market that is controlled by some very clever, greedy, well-organized guys that pretty much have their mind set on taking your money. So they are what we call the clever money in the market, and you and I, we are what they call the dumb money in the market. So we just want to be a little less dumb. There's no reason just to give our money to them. And if you want to actively invest in stocks, you don't have to. You can put your money into some mutual funds or ETFs, as I mentioned before, and I'll mention in other videos as well. But if you want to be actively investing, you should set aside some time to watch some of my upcoming videos about how we do this. It can be very lucrative, but it also takes quite a lot of time. I hope this made sense. We have the technical analysis looking at charts, the fundamental analysis looking at all the numbers and the quality of the company, and we're going to find some balance between the two to be the best investors we can be. That's all for now. I will get back to you soon with more videos about investing and all sorts of other ways of making money in the markets. Talk to you soon. Be careful out there. Bye for now.